Zoom stock taking a hit in early morning trading on Tuesday after the company reported its recent earnings results. What was in this report that has Wall Street so upset? Here's everything you need to know in about 10 minutes. My name is Brian Feroldi. As of the time of this recording, I do own shares of Zoom Video Communications, which is all the way down to about a $22-ish billion market cap. This is the company's Q3 of 2020, fiscal year 2023 report. Revenue for the quarter grew 5% to $1.102 billion. That exceeded Wall Street's estimate and management's own guidance. Earnings per share declined 4% year over year on a non-GAAP basis to $1.07, blasting past Wall Street's estimate and management's own guidance. So the headline numbers looked good. Enterprise revenue for the period grew 20% to $614 million, now making up 56% of total company revenue. That is definitely a positive trend for investors to continue to watch. Management noted that they had a strong quarter for Zoom Phone and Zoom Rooms and other products, so they continue to make great progress in the enterprise space. The number of enterprise customers grew 14% to 209,000, and the number of customers that are spending at least $100,000 with Zoom every year grew 31% to 3,286, and that now makes up 27% of total revenue. So Zoom really getting it done in the enterprise space. Speaking of that, the company's dollar-based expansion rate was 117% during the quarter. This is just for enterprise customers. So the enterprise space is looking good. Now, from a churn perspective, online average churn, that's for regular customers like you and me, this actually declined by 60 basis points to just 3.1%. So they're seeing lower churn in this metric, and this was actually down from 3.6% last quarter. This number is returning to pre-pandemic levels after the pandemic's effect are finally becoming a thing of the past. Remaining performance obligations grew 32% to $3.24 billion. Non-current, meaning obligations outside of 1 year, is growing, and current obligations grew 18%. So customers are signing up for longer-term contracts with Zoom. Again, another positive sign. Let's take a look at the financials. Gross margin expanded by 350 basis points to 79.5%. Operating margin and net margin both declined year over year. I'll have more to say that in a little bit, but this was definitely the low light of the report. Free cash flow declined by about $100 million to $273 million. Net income dipped slightly. This is on a non-GAAP basis. On a GAAP basis, the decline was much more severe. And the balance sheet remains pristine, $5.1 billion in cash, $0 in debt. Let's take a look at some of the company's margins on a more detailed basis. So again, gross margin here growing 356 basis points. Big jump. Nice jump. Great to see that. R&D expenses also expanded by 335 basis points. That is a big jump. However, management is purposely doing that, and they expect to get that range in the long-term range of 10 to 12% of revenue. So expect that number to continue going up. Now, they are using that R&D money effectively. Look at all the products that they now have right now, and it's clear that many of these products are being adopted by their customers, especially their enterprise customers. So that appears for the time being to be money well spent. Sales and marketing expense. This to me was one of the big lowlights of this report, jumping 469 basis points to 27.3% of total revenue. A big jump in sales and marketing expense. They are investing in quote unquote their sales capacity and channel partner expansion. I don't really like to see that big of a jump in sales and marketing expense, but hey, it is what it is at this point. On the bright side, G&A expense, overhead expense, barely budged year over year on a percentage of basis. Now, another low light for me this quarter was the enormous jump in stock-based compensation expense, almost tripling the year-over-year period to $302 million. That is a huge, huge jump year over year. This is consistent with what we've seen at a lot of other tech companies, a big, big jump in stock-based compensation this year, but that to me was, again, a low light of this report. On the plus side, the company is actively buying back stock, spending about $991 million year to date on buybacks. while generating $737 million in free cash flow year to date. So while the cash balance only declined by about $300 million, the company is using a lot of capital to buy back stock. And check this out. On a diluted basis, the share count declined by 1% year over year. So while the company's stock-based compensation expense is high, the diluted share count is declining by about 1% year over year. Turning to guidance. Next quarter, revenue is expected to grow 3% to $1.1 billion, below what Wall Street was estimating. Earnings per share are expected to decline 40% on a non-GAAP basis to 77 cents, again, below what Wall Street was estimating. This is likely to be why shares are under pressure today. Management is saying that its enterprise business is expected to grow in the low to mid 20s. Great to see. However, the online business continues to decline and be under pressure as the effects of the pandemic weigh off, and this business is expected to decline 8% year over year. For the full year, management is guiding for about $4.375 billion in revenue, roughly in line with what Wall Street is expecting. Earnings per share for the full year are expected to decline 23% to $3.92, above what Wall Street was expecting. What should investors watch moving forward? First and foremost, keep an eye on enterprise. This is the bright spot. We want to see this number continue to grow as the overall percentage of revenue. Second, keep an eye on that online churn. Definitely a good sign to see it declining year over year. We want to see that continue to happen as the effects of the pandemic wear off. Third, keep an eye on operating margin, specifically spending on the sales and marketing. The big jump this year, we want to see start to decline on a percentage basis moving forward. Fourth, watch free cash flow and what they do with that free cash flow. The stock buybacks hopefully will continue. Overall, when I go with this report, I can't help but think that the moat here is stable, if not widening slightly as they roll out new products and get more penetration in enterprise basis. And the thesis here, I would put somewhere between yellow flag and green flag. Yes, they are making progress, but the big move back in the operating margins are worth watching. But this is definitely not a thesis broken situation at all. It's a yellow flag rapidly trending towards a green flag. In terms of our investing frameworks, this company got a 78 on my investing framework, very much in my investable category, an 11 on the anti-fragile framework, very much investable in Brian Stoffel's category. Turning to valuation, where is the company on this growth chart? The answer is very clear to us in the maturity phase. Revenue growth has slowed substantially. Profitability is there. For that reason, when we think through the company's income statement, all of the numbers are essentially optimized right now, at least on a non-GAAP basis. Not on a GAAP basis, but on a non-GAAP basis, they are. For that reason, we can use the price to sales ratio, the price to gross profit, price to earnings, price to free cash flow ratio. All of these numbers are meaningful for letting us know how the company is currently valued. So let's take a look at some of those right now. So on a price to sales ratio basis, currently about 5.7 times. That is below, well below the company's pandemic peak of about 124. This company traded 124 times sales in late 2020, currently trading about 5.7. You're knocking the 10% off that. You're getting to about 5 times sales. Market cap for this company once exceeded $158 billion, currently about 24, knocking another 10% off, getting to about 22 billion market cap. On a gross profit basis, 3.2 times gross profit. That gives the company a price to gross profit ratio of between 6 and 7, somewhere around there, starting to get very interesting. Price to earnings ratio, about 25 times earnings, trailing basis. Again, knocking another 10% off that, gets you to 21 times earnings on a trailing basis. On a forward basis, that gets you to about 19 times earnings on a forward basis, and on a price to free cash flow basis, only about 19 times price to free cash flow. So if this company was expected to stop growing forever, I would say it would be overvalued even after this decline. But if you anticipate any growth at all, I would say this company is starting to get very attractive. So what does Wall Street expect to happen from a revenue perspective moving forward? Well, for this year, $4.4 billion in revenue, moving up to $4.7 billion in revenue next year. The year after that, about $5 billion in total revenue. So revenue is still trending in the right direction. Nowhere close to as fast as it once was, but this Wall Street is currently expecting that this company is going to continue to grow. One other thing that's worth noting, when we think through how the decline in stock prices affects different companies. For some companies, that are in the raising capital mode, the big decline in stock prices is a big time threat. For other companies, the decline in stock prices is a big time opportunity. Zoom is very clearly in this category here. They are actively returning capital to shareholders. They are actively buying back their stock. They could use their cash hoard to make acquisitions. So the decline in share prices represent a big opportunity for this company. It is not a threat. This is a company that I do own, and this price is getting very, very attractive to me. I still think this is a very high quality business. The valuation is getting more and more compelling moving forward. And if this business can continue to penetrate the enterprise, continue to roll out new products, and continue to funnel its free cash flow to shareholders through stock buybacks, this could be a stock that I would be very interested in adding to in the near-term future. Hope you found this review to be useful. See you in 90 days on this one. Brian, out.